Welcome back to the Uncovered Economy. Oil just exploded higher, and when oil explodes during rising global tension, markets pay attention. This is not just a small price fluctuation. This is not noise on a chart. This is the kind of move that historically signals a shift beneath the surface, and if you ignore it, you may miss what comes next. Because oil rarely moves alone. It tends to lead, and when it leads, silver often follows. Before we go any further, if you want real macro breakdowns focused on what actually moves U.S. markets, make sure you hit subscribe right now. Timing matters in cycles like this. The difference between reacting late and preparing early can be massive. Oil's breakout may be the early warning sign. Silver could be the response. And most people won't connect those dots until it's obvious. Markets do not wait for confirmed war. They react to rising probability. The moment headlines shift toward escalation risk, traders reprice assets. Energy markets move first because supply risk is immediate. Roughly 20% of global oil moves through geopolitically sensitive regions. Even the threat of disruption can push crude sharply higher. Energy traders do not require certainty. They require risk assessment. That is exactly what we just saw. Oil pushed through resistance levels that had capped it for weeks. Volume increased, momentum built quickly. And that type of breakout usually carries implications beyond gasoline prices. It sends a message about inflation. It sends a message about policy pressure. Now think about what higher oil means inside the United States. It means higher fuel costs for transportation. It means higher costs for food distribution. It means higher operating expenses for businesses already managing thin margins. Energy feeds directly into inflation expectations. And inflation expectations directly impact interest rate forecasts. If oil remains elevated, inflation narratives return quickly. If inflation narratives return, the Federal Reserve faces renewed pressure, raise rates further, and risk slowing growth. Hold back and risk inflation rising again. Either path creates uncertainty, and uncertainty fuels demand for hard assets. Silver does not need confirmed conflict to move. It needs monetary tension. Oil may have just triggered that tension. Oil rising is not just an energy story, it is a monetary story. When oil climbs sharply, inflation expectations rarely stay flat. Bond traders begin adjusting models immediately. They do not wait for CPI data to confirm what energy markets are already signaling. They anticipate the ripple effect through transportation, food, and manufacturing. That anticipation shifts real interest rate expectations. Real interest rates are what matter most for precious metals. When inflation expectations rise faster than nominal yields, real yields fall. When real yields fall, holding non-yielding assets becomes more attractive. That includes gold. But more importantly for this discussion, it includes silver. Silver tends to react more aggressively than gold once momentum builds. Its market is smaller, its volatility is higher. Historically, oil spikes have often preceded silver surges. In the late 1970s, oil shocks helped ignite a precious metals boom. In 2011, commodity strength and global instability pushed silver toward historic highs. In 2020, after initial volatility, metals surged once liquidity entered the system. The pattern is not coincidence. Oil drives inflation narratives. Inflation narratives influence monetary policy. Monetary policy uncertainty supports metals. Silver amplifies that move because it sits at the intersection of monetary hedge and industrial demand. It is not purely defensive like gold. It also benefits from infrastructure and technology demand. That dual identity makes it explosive when macro forces align. Right now, alignment is forming. Oil has broken out. Inflation risk is creeping back into conversations. The gold to silver ratio is another indicator worth watching. When fear first rises, gold leads. But when inflation narratives strengthen, silver begins catching up. The ratio compresses. Compression often signals silver outperformance. If oil remains elevated, that compression becomes more likely. That is where acceleration begins. Silver rarely moves gradually during compression phases. It tends to surge through resistance quickly. Investors who wait for confirmation often enter after the strongest portion of the move. Institutional money positions. Before headlines shift tone, that positioning builds quietly beneath the surface. Oil's breakout may be the early stage of that buildup. Silver is watching closely, and markets rarely give long warnings before momentum expands. From here, markets face three realistic paths. The first path is de-escalation. Tensions cool, headlines stabilize, and oil retraces part of its breakout. In that scenario, inflation pressure eases temporarily. Bond yields stabilize. Volatility fades gradually. Silver likely consolidates rather than explodes higher. The risk premium priced into energy markets fades over time. This would turn the oil spike into a short-term event. Precious metals would drift instead of accelerate. Investors would refocus on domestic economic data. Markets would return to watching employment numbers and retail sales. The Federal Reserve would regain breathing room. Real yields would stabilize. Silver would remain range-bound for a period. The second path is prolonged tension without direct escalation. Oil remains elevated for weeks or months. Inflation expectations stay firm. Bond markets remain sensitive to energy prices. Investors slowly increase defensive exposure. Silver begins grinding higher instead of spiking in a single day. This environment historically favors steady metal rallies. It creates slow-burn inflation narratives. Policy uncertainty grows gradually. The Federal Reserve faces persistent pressure. Rate expectations become unstable. Real yields remain vulnerable to decline. That alignment supports silver's upside potential. Momentum builds beneath key resistance levels. Eventually, resistance breaks. The third path is rapid escalation leading to broader financial shock. In sudden shocks, liquidity becomes the immediate priority. Investors may sell risk assets aggressively. Sometimes, even metals are sold briefly to raise cash. We saw this during the 2008 financial crisis. We saw it again in early 2020. Liquidity squeezes can distort short-term price action. However, once central banks respond, metals often rebound strongly. If policymakers inject liquidity, inflation risk increases. Inflation risk supports hard assets. Silver can move violently during these transitions. Short-term volatility may be extreme. Long-term direction often favors tangible assets. Oil remaining elevated amplifies that possibility. Duration remains the key variable. Now let's bring this back to you. This is not about panic. It is about positioning with awareness. Oil has already made its move. Silver is positioned beneath resistance. And markets rarely wait long once pressure builds. Understanding the signal is more important than reacting emotionally. If oil sustains its breakout, inflation narratives return quickly. If inflation narratives return, policy pressure increases. Policy pressure creates uncertainty. Uncertainty fuels defensive allocation. Defensive allocation benefits metals. That chain reaction is logical. It is not speculative. It is structural. Silver is volatile by nature. It does not move in straight lines. It surges, retraces, consolidates, and then often surges again. Strong moves frequently begin quietly beneath resistance. Momentum builds before headlines catch up. Retail investors usually enter after confirmation. Institutional capital often enters before confirmation. Oil's breakout may be the early positioning phase. If oil holds these levels, silver's breakout probability rises sharply. If oil climbs further, the probability increases again. Markets reward anticipation more than reaction. Waiting for certainty often means missing opportunity. This is why macro signals matter. Oil just sent one. Now I want to hear from you. Do you believe this oil breakout is temporary noise? Or do you think we are entering another inflation-driven cycle? Drop your thoughts in the comments below. I read every single one. Real discussion sharpens understanding. If this breakdown helped you connect the dots before mainstream headlines do, share this video with someone who follows gold, silver, or energy markets. Most investors react late. Markets move early. Oil already moved. Silver could be next. This is the uncovered economy. We focus on signals before they become obvious narratives. Stay disciplined. Stay analytical. Stay ahead of the curve.